All right, let's take a look at absorption and variable costing. And this is part of your chapter 3 in your ebook. Traditional income statement required by GAAP, which is what we learned in Accounting 101, how to do an income statement. And we also, those of you that are in Accounting 201, doing the same thing. Okay? And we classify costs and expenses by the function of them. So any kind of product costs are put into cost of goods sold, and we put that on the income statement. We subtract it against the net sales to get gross profit. Then the other costs that relate to the office are called period costs because they happen, they're not a costs that are attached to a particular product, and we wait until the product is sold before we subtract that cost from the sale. With a period cost, it happened during the month of May or whatever, and so we're going to subtract it during that period. It's not attached to a product. So that is how GAAP requires us to do an income statement, to divide the costs out between those that are attached to the product, and if that's a merchandiser, we use FIFO or LIFO or whatever to calculate out how much belongs to the ending inventory products, how much belongs to the cost of goods sold of the items that got sold. If we're a merchant, if we're a manufacturer, however, the product costs are calculated by direct materials, direct labor, and the applied overhead that went into those products. And so we have to have a way of adding up those things for the products and knowing how much it cost us for each product, and then we can subtract that from the sale. And that becomes our cost of goods sold. So that's how we do things traditionally. Now, management tends to use a contribution margin income statement, and that classifies costs by how the costs behave as opposed to the function of the cost. And so variable costs, as we know, vary according to the volume. So if we build more dog houses, we're going to have more direct materials. We're going to have more lumber and shingles. And so that would be a variable cost. Fixed costs are those that remain the same all the time, like rent for the factory building would remain the same regardless of how many dog houses we build. And so this contribution margin income statement, this variable and fixed cost classification is much more useful to managers as opposed to the traditional income statement way of doing things. This contribution margin income statement will not be handed out to creditors or investors or anybody outside the company. Okay, again, absorption costing is what is GAAP. That goes out. Those are the income statements that go out to investors and creditors that have the product costs and the period expenses shown on them. The variable costs used by management, and they have the variable and fixed costs on that contribution margin income statement. So here's the absorption costing income statement, the one that's GAAP. Okay, we take our net sales, that's our gross sales minus any contra revenue accounts, such as sales returns and allowances and sales discounts. Those are subtracted from the overall sales to get net sales. And we subtract out our cost of goods sold for those same items that we're showing the sales for. Okay, and that shows us the gross profit that we made on those items that we had sold. Then we're subtracting out our operating expenses. These are basically our period costs, okay? The wages expense, rent expense from the office, okay? From the marketing area and from the office administrative area. Those expenses, period costs, are called operating expenses. We're going to subtract those. Gross profit minus the operating expenses is called income from operations. And sometimes we'll just use the word operating income. That's the word management likes to use better as operating income, but typically on the income statement, the GAAP related income statement that's going to creditors and debt and investors is called income from operations. Now, this variable costing income statement, the contribution margin income statement, okay, takes again our net sales, so that number's the same. But now instead of subtracting cost of goods sold, we are subtracting variable costs. Those are the ones that vary depending on how many units we are producing and selling. Okay, so in this case, the variable costs are both from the factory and the office. So if I have direct materials, that's a variable cost from the factory, that's part of this. But also if I have variable costs from the office, like let's say we pay a commission, a sales commission to the salespeople, okay? And so however many they sell, they get a bigger sales commission. So that commission that we have to pay is based on how many are sold. So that's a variable cost as well, only it comes from the marketing side of the office. So it doesn't matter where the cost comes from. If it's a variable cost, we're going to subtract that as a variable cost from the net sales. And that gives us the contribution margin. Then we're going to subtract all of the fixed costs. And again, we don't care if it's rent of the factory building or rent of the office building. Okay, it's a fixed cost. It's then going to be subtracted from contribution margin to get operating income. Now, if we had any mixed costs, those are costs that are part variable and part fixed. Okay, we can't have those for this variable costing income statement. And management is going to use this to make managerial decisions, this information from this variable costing. So we can't have mixed costs. If you have any mixed costs, those have to be made into variable and fixed to begin with before you do the variable costing. Okay, before you do your contribution margin income statement, you need to make the mix, take the mixed costs and divide those out into variable fixed. Okay, and we talked about that in previous PowerPoints, etc., how to do that using the high-low method. If you want a quick and dirty method, we can use regression analysis on Excel, etc. Okay, so here this slide shows you again the comparison, the traditional absorption costing income statement, net sales minus cost of goods sold, which are the product costs, gross profit. and minus the selling and administrative expenses, our operating expenses, those are our period costs, and we get operating income or income from operations. Okay, that's the absorption costing, our traditional GAAP income statement. There's some variable and some fixed product costs, and there's some variable and some fixed period costs. The contribution margin income statement is what we use for variable costing. And again, the net sales minus the variable cost, doesn't matter if they're from the factory or the office, all variable costs are subtracted to get contribution margin. Then we subtract all fixed costs. Again, it doesn't matter if it's a fixed cost that should be part of the product from the factory or it's a period cost from the office. It doesn't matter. All fixed costs are then subtracted. We get down to operating income. Is this operating income the same as that operating income? Yes. We're just dividing out how we show the cost differently, but it's still all the costs are being subtracted from the net sales. So we still will end up with the same operating income. If we want to take a look at the contribution margin per unit, which is part of variable costing, again, we can take the sales, the net sales minus the total variable costs, and that gets us the contribution margin, the total contribution margin, and then we can divide that by how many units. We can also figure out the sales price per unit minus the variable cost per unit. And again, that variable cost is not just for the product. Variable cost from both the factory and the office, from both the product and the period. Okay? Anything that's variable that belongs, that's part of that unit. Okay? Then that will be subtracted from the sales price for one unit, and that will give us the contribution margin for one unit. Okay? We make a lot of managerial decisions based on that per unit basis, and the contribution margin per unit becomes important.